Great to be here.
I don't want to. I mean, I could start with why you're shaking your head about the profits piece, but I don't want to get right to that point just yet. Let's start overall with the argument, which I think we can make a very different case. So let's hear it from you. Why do you think the economy is so strong, perhaps even picking up momentum, that the Fed needs to do more aggressive rate hikes right now?
Well, I think the Fed needs to stick to what it said it was going to do. They were talking about a terminal peak Fed funds rate of, 5.25, maybe a little bit higher. And I think that's where they're going to have to go. They need to get the Fed funds rate positive in real terms. What
they have, right? So now that we're where we are against, you know what I'm saying, the 4.4% for the core PCE. Come on, we're above that rate. We're restrictive now.
Let's see. So 4.75 on the most 4.34, you said? Well, all right, maybe. But in history, we've not had a significant disinflation until Fed funds was positive in real terms relative to the CPI. But I'll take core PCE or whatever you want to throw at me. We're not restrictive. We're probably maybe neutral, but neutral doesn't cool things off.
One more to you, Larry, that I want to bring Steve in to debate this, but it is quite unusual, or maybe it's not, to see the index of leading indicators as bad as it is, the yield curve inversions as bad as they are, and yet the kinds of job numbers we're throwing up. Do you worry that these reports are a little bit of a head fake, that this slowdown just hasn't caught up with the labor market yet, and that the Fed could overreact to the strength in that one part of the economy?
Well, we know the labor market hasn't caught up to the economy. It is an extremely tight labor market. And despite that, real wages are down about 3.5% since the beginning of 2021. Well, if you have declining real wages, you have to fix that before you're going to fix the labor market. And higher real wages means wages go up faster than prices. And who gets squeezed if wages go faster than prices? It's going to be profits. You can't get there from here without a profits recession.
Steve?
Well, first of all, I want to agree wholeheartedly with Larry, not even in the current circumstances, but my work, Larry, suggests that the Fed funds rate ought to be positive no matter what. That it's only in the weirdness of the last 10 years that we have had a neutral or negative funds rate or negative real funds rate, and that if you're talking about what is restrictive, it ought to be 50 or 60 basis points, depending upon what era you use or look at. So if you want to be restrictive, it should be 100 over. That would be restrictive, okay? Now, there is a debate about which particular inflation rate you use. For example, if you use the 3-month annualized rate of inflation over the last several months, then you would be actually positive, and positive by 100 or 200 basis points. So there is that question, and I think Larry's being sort of orthodox here. Would that be a fair way to put it, Larry, in terms of using the year-over-year rate?
Steve.
I know you are, Larry. But let me just ask you this question. We have seen a ton of industries that are still running below their pandemic level, a ton of industries in terms of employment that need to still play catch up. Why should the Fed lean against that adjustment? We have tech companies shedding workers they overhired. Other companies were still, we may be hundreds of thousands of nurses short, Kelly. And you can't argue in this country with our aging population that we need fewer nurses than we had before the pandemic. So, Larry, I'm just afraid, should the Fed get in the way of that transition?
Oh, well, I don't know they're getting in the way of it. I think the employers may be getting in the way of it, right? How do you fill vacancies? Well, you fill vacancies by raising wages. And so far, they feel they haven't had to do that. They are going to have to do that in order for the labor market to clear.
Can you expand on that, Larry? I mean, we're talking about coming off a period where we've seen wages probably go up 10 to 15% on aggregate in the past couple of years.
Real wages, by any measure, are down in the last 2 years.
Right. But now employers are going to say, we're not giving real, if anyone was giving you a salary hike in real terms, like, watch out. They're just saying, nominally speaking, we've given people actually these wage hikes, and you're saying they need to go even faster. And again, people listening to this from the investment side are going to hate what you're saying.
Of course they're going to hate it, because the reason they're going to hate it, the reason a businessman would hate it and resist it, is if you raise wages faster than you raise the prices you charge on your output, you're going to have a profit squeeze.